Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. G'day, Matt. Welcome to the show, Matt.
Thanks for having me on. Very excited to be here.
Yeah, I love having you on the show. Here's a bit of trivia for you. Have a guess whose Australian Investors podcast episode has been the most popular in 2020?
2020, I'm not sure.
Yeah, mate, it is yours.
Cool.
I'm not sure if you're just sharing it anywhere and everywhere. But,
yeah, I've been knocking on doors, check this out, putting flyers out. So
yeah, no, it's been great. And I think just there was a lot that resonated with people from our discussion in what I'll call season one of the series. I just think, some of the insights you bring are really, really valuable to a lot of our community. So I'm eager to hear how coronavirus has played out in your mind and how you're seeing that for your fund and what you have going on. But maybe just to kick things off, what we can do is, for anyone that hasn't perhaps seen the first installment of me talking to you, you can just give us a rundown of you, a bit of your history, and I guess Maven Funds and where you're up to with that.
Yeah, sure. So yeah, that podcast, we go into a lot of detail. It's a really cool interview, more than I've done anywhere else. But yeah, so I'm Matt Joass. I'm the Chief Investment Officer of Maven Funds Management. So Maven Funds Management, we're a Sydney-based investment manager, and we try and find small, fast-growing companies that are small today but have the potential to be kind of the big, dominant businesses of tomorrow. So we're trying to find those companies early in their growth journeys, ideally when they're just tipping past what I call like a fundamental inflection point, where the fundamental cash flow is about to get a lot better for them than they have been in the past. And building a really high conviction thesis, a lot of research, and attempting to hold on for the long term. It won't always happen. Sometimes we need to sell quickly if our thesis is broken, but ideally holding on for the duration of that kind of high growth period, I guess. And so yeah, we're launching our fund next month, the Maven Smaller Companies Fund. So Australian and New Zealand businesses, again trying to focus on the smaller end, but being willing to hold kind of throughout that duration of that high growth period. And my background, I'd previously run a portfolio service for Motley Fool Australia, Motley Fool Pro. So excited to be, I guess, doing it again. It's a pretty amazing time, I think. Obviously, it's there's a very serious health challenges we all have to be very cognizant of and doing our part. But I think from an investing perspective, it's we'll talk about that a lot more. But it's a pretty interesting time and pretty keen to get started.
Yeah, it's an interesting time for everyone, not, obviously not just investors, but our, I guess, political system, consumers, businesses, just everyone involved. But I guess for you too, you've got quite a few balls up in the air that you're trying to juggle. Obviously getting the fund off the ground and taking that leap is one thing, and then dealing with all of this, you could say, quote unquote, unprecedented times. It's quite challenging. So I mean, credit to you for pushing through and coming out the other end and trying to deal with some of the administrative issues, which for anyone that's been involved in funds management knows can be quite challenging, to say the least. So that's great. You said that the fund is launching next month. I just wanted to circle back to that. Just for anyone that maybe watches this at a later date, we are recording this around mid-April, so that means May 2020. But Matt, you've given us an overview of kind of the overarching philosophy. People can go back and listen to the first episode. What are you seeing from a bigger picture point of view? I know that's a very generalized question, but maybe we can dive into some of the specifics. But just in terms of the coronavirus, some of the things that have jumped out to you in recent months.
Yeah, so I've been tracking it for a few months. To me, I think at first in kind of January, I was similar to a lot of other folks who kind of saw that maybe this is just going to be contained, and kind of using the parallel of like SARS in 2003. Late February, I started to have a very different view on it. It got, I guess, taking a step back. Like at school, I loved studying history, And I think people misunderstand that history is about understanding the past, and to me, it's about understanding the future, because you can see how different things can be. And so I just started to see how easily that parallel of the previous pandemic, which the last time we had something was obviously 1918 with the Spanish flu, and what that could mean. And it just kind of got a bit crazy there, because we were running up at the same time. We had a lot of stimulative kind of euphoria, and the markets are running incredibly hot. And it got to a point where I think a lot of the market was just discounting it way too aggressively that it could happen. Another thing I focus on a lot with investing is exponential growth, like you. So I think it's just a bias that it's interesting in the investing world. It started to get more change. You see a lot, particularly venture capitalists. A lot of them have been posting on Twitter about that in America, trying to get people aware of what's happening. But if you step outside of that, most people don't think about exponential growth at all. We think linearly. Our brains evolved to handle a lion running at us in a line. They don't run exponentially, so we're not designed to think that way. I could just kind of see this confluence of things coming together. We could see how much of a shutdown was required in China. So yeah, coming in towards the end there, I got, I wouldn't say like bearish. I don't think about things in a market level. I try to think about things bottom up, but I just saw so many businesses which would have real big impacts. And there's a lot of been made about the shutdown and government decisions. We're very lucky, the countries that we live in, Australia, I'm originally from New Zealand. I think that we've been able to hammer this down very aggressively, and we think we can rebound more quickly. But there wasn't really good scenarios, I guess, if you're coming at that time. You could let it run the course, and that would be extremely devastating. You have a health system collapse and a lot of consumer collapse just because no one wants to catch the virus, or you shut down, and that has its own kind of sudden stop dynamics. So yeah, for me personally, I kind of moved, there's a lot of change in my portfolio, I guess you'd say. I moved a lot to cash in late February, and yeah, really excited now because I think there's a huge amount of opportunities, putting that to work very soon. But I think that the thing to keep in mind, and we'll touch on this a lot more, but it's really, I don't think investors, particularly if they're individual investors, should be thinking about the market. And everyone's trying to, the whole way down, people are tweeting, is this the bottom, is this the bottom? And maybe we've seen the bottom. It doesn't really matter to me at all. All that matters is there's this huge divergence in outcomes between different companies, depending on how they handle this. And that's what gets me like very excited and interested. You see the whole market moving in one direction because of something that Trump tweeted or whatever else. And I think if you really, it does take thinking into the fundamentals of the business, but there's just vast opportunity of businesses that can handle this well and that have been priced like they can't. And on the flip side, the things to avoid are businesses that have been priced, forgetting that this is even happening, even though it's going to have a very potentially detrimental effect on their competitive position. So yeah, that's kind of what, yeah.
It's quite an overview you just gave us. Maybe we can start. I know you're not necessarily a top-down thinker. You don't think, like you try to see the forest from the trees and what have you. But you mentioned something there where you said that Australia is probably, we're very lucky and we might bounce back quicker from this than some. Can you just flesh that out? Like, what makes you think that?
Yeah, so it was quite weird, like just thinking how much the world's changed. Like people forget how crazy the world we live in now is compared to base rates. I kind of I did a tweet storm about this in like early March, and it's tweeted about in late Feb, just trying to just take that step of shutting the border at that stage, which everyone thought was impossible. Like the chief medical officer of Victoria and others were saying we can't do any more shutdown in China. Because the thing is, if you just stop that, then all you lose is international tourism, GDP. And that's big, but it's not nearly as big as people think, and is dwarfed by how much Australians spend abroad and how much Australians spend traveling domestically. So if you do that, you could actually have a substitution effect and bring it back home. But what's worked well is Australia had a big advantage. We've got a great medical system, and we had the advantage of seeing everyone else go first. So we've been able to take steps combined with, I think, really effective institutions and been able to shut down aggressively early to a point where I think elimination is like a very viable outcome. And elimination is radically different. That's kind of what I was proposing with shutting the border early, is you take some pain, but you avoid any other pain for the rest of the economy, because you have shutting international tourism alone would be maybe 1 to 2% of GDP impact. But if no one goes out, it's a very, very big impact, right? And so I think that now we're in a good position because we've got case numbers so low, more people are recovering than getting infected now. And same with New Zealand, where I think what's going to happen is the world's going to change into green zones and red zones, and maybe some kind of yellow and orange in between. But there'll be places that have completely effectively stamped it out. And I think Australia is likely to be one of them. And I think that there you have a return to normal much more rapidly. And you probably have some relief of everyone going, that's nice. It's nice to be able to go out to a restaurant again. And maybe you have some more frictions added to that society. So you might have temperature checks going into buildings. You might have some kind of voluntary use of a tracing app. You might have people wearing masks, which are all things that I definitely recommend. But you don't have this prolonged effect of either government mandated or bottom-up driven avoidance of consumption. And I think other countries are definitely not as lucky. United States has a lot of challenges. Even it's just so uncontrolled there with over hundreds of thousands and coming up to over 500,000, or over 500,000 now, I think, infected. It's so many. It's so hard to control. You start lifting again, but then the R0, the spread rate will increase. And I think, we're in a very fortunate position. And I think that means our companies, even the ones that are internationally exposed, which is a lot of what I love, are probably relatively better positioned than a lot of other peers. So well positioned. I'm hoping it goes that way, and we get kind of a green zone, and then you can have other countries that are part of that network. So New Zealand, Singapore, other parts of Southeast Asia, even China, being able to exchange tourists again with them, maybe with some frictions and maybe some rapid testing at the border. But that opens things up so much more quickly, and you have everything else come back as well. Restaurants and leisure and domestic tourism have a huge campaign, give everyone some money and travel around Australia. So it's a fascinating time. I think you just need to be aware and observing of what's happening.
When you talk about this, it's a really good way to frame it insofar as these buckets, if you like, or these colors. When you think about bottom-up analysis and you're valuing companies, how does the currency impact your valuations and your thinking? Because you mentioned there that some of the domestically listed businesses, so ASX listed businesses, or even in New Zealand, that do a significant part of their business overseas, but you have to factor that in somehow, right?
Yeah, it's basically a tailwind for most of the businesses that I look at, particularly the moves that we've seen already. So the Australian dollar falling, they earn, many of the businesses I look at might earn 90% of their revenue in USD. That's pretty nice when you're Australian or New Zealand-based business. So it is something I don't try to forecast that, and I'd probably, if anything, just have a buffer there. So I won't take the current Australian, latest price of it's at all-time lows of 60 cents or something. Maybe stick to kind of a higher average price that we'd seen before, maybe closer to 70 or something like that. Just leaves. I don't want that to be. I don't want to be. If I'm going that fine-tuned, where the 5% move there makes a huge difference, probably means the business case itself doesn't stack up, because there should be a kind of an overwhelming discount to my estimate of intrinsic value. But that's something you need to think about. I think if there was it is just like another macro thing. I think it's pays to be like aware of them, even though you're bottom up focused. If there was some reason to think the Australian dollar was going to rally super hard, that would be something I'd be thinking about. At the moment, it's kind of moving, in the favor of those kind of companies that are domestically listed but with international operations.
Yeah, it's an interesting one. While we're in the weeds on this, and I know some people listening to this might be like, what are they talking about? But
that's all right. Weeds are good.
Yeah, they are. When it comes to valuations and how you think about, your modeling and that type of thing, obviously interest rates factor into most models that we create as analysts. How are you seeing that in terms of, interest rates US, here in Australia? They're pretty low at the moment, right?
Yeah, fascinating question. Something it's not just now, it's the past 10 years, right? Because we've seen this decline to almost zero now. I guess the way I think about it is generally being pretty sticky to what interest rates had been in the past. I'm not trying to purely just stick with some number, but that's kind of where I'd lean towards. When I say some number, I mean my required rate of return. So I don't really go much below a cost of equity, get into the weeds of around, say, 9.5%, 10%, around there is probably what I look for. And then I think what that does is it does make it, you have to be more disciplined to buy because you're not lowering your kind of standards as the market does. It does force you to be more picky. And I think the only thing you need to balance that with is it should force you into the best investments, basically, as long as you're doing it well. But you need to just balance that with making sure you're having enough. Like if you only have one company that returns because you're using a super high, goal return on capital, then that's not realistic. So that's probably the only thing, but it's been working well so far. So I'm just not, I don't want to give full credit to it, I guess. It makes the work, you have to do more work, but I think that's the trade-off. If there was a point where I felt comfortable that the low interest rates were permanently here to stay, I'd be more comfortable baking that in. But I prefer it just forces you to work a bit harder.
Yeah, it's one of those things, right? Because as an investor, you have an expected rate of return, but and you want to be stringent in your criteria, but at the same time, you don't want to miss out on opportunities because you have arbitrarily added 1% in your discount rate versus what might otherwise be the case, and you might move into a position. So I'm always keen to pick your brain on that. But before, if I could change gears again, you mentioned that there's going to be a wide range of outcomes effectively for different types of companies. So, we might have companies that thrive in this environment and actually emerge from it much stronger than they may have otherwise. But then we'll have companies that, we can see almost the white writings on the wall. We've seen some capital raisings. How do you think about that? You might have examples, you might not, but how are you thinking about that from a bottom-up perspective?
Yeah, it's great. That's exactly right. That's what we're looking at. There will be companies that go bankrupt. There'll be others that thrive, and some will be resilient. I think it really comes back to really deeply understanding what the business does. So really, it's not that much of a change to my process, but most of the time that we're researching isn't the valuation piece. It's understanding the business, and is this the type of business or the type of characteristics we want? And that means really understanding the model. It's surprisingly difficult to understand exactly what a business does. That's most of the questions I'm asking when I meet with management. And when you do that, you can understand how it fits together with every other part of the economic system, if you like. And I think that going through those base principles, you can see all the things that are affecting the economy right now. Like there's no leisure spending. People are spending time at home. But then you have to think through all the behavioral impacts that that's seeing. And what you want to do, I think, is come up with first principle thoughts on that, and then try and sanity check that with channel checks or talking in the real world. I think a lot of the finance world is in a bubble. A lot of investors forget, just how lucky we are to be investing at all. Like you're a small portion of the population even owns stocks, and you do a lot of good work trying to get other people to get into investing. But it's, I think, stepping outside and understanding how it really works. So I'll give you one, and I should say when I'm looking at companies that thrive, for me, I'm a long-term investor, so I'm not looking to do trades. So I wouldn't be looking to do a face mask company. And there's nothing against that. Like that, there will be people who make good money if you're early in buying a face mask company. But that's not a business I want to own in a year's time, right? Once this is over. But there will be other businesses where this gives a boost to them because it accelerates the adoption curve. It kind of brings forward the inflection point, if you like, of kind of mass adoption. And so that's one thing that I'm looking for. But to your question of what type, so an example. So a great example of people that were trying to put on a trade would be like InvoCare and funeral homes, right? So people, pretty dark kind of trade, were thinking there's going to be a lot of death from this, and so that share price started rising. But they hadn't really thought that through, I don't think, because just looking at Italy at that point, they'd already banned funerals, right? So that was one immediate thing that it's very hard to run a profitable business if you've banned the main thing that you do. And then the second is, if you do shut down early, you can actually have a fall in total number of deaths in society. I think that's what we'll see in Australia. Although there are, tragically coronavirus deaths, there'll be less deaths total if you shut down early enough because there's less traffic, there's less like accidents. So there's some numbers already starting to come out showing that. So it's just really thinking things through clearly, I guess, like what are all the flow-on impacts of this, and how does the business model deal with that? So one is the thrive, where they bring forward a kind of inflection point and adoption. That's really interesting. Another is just really high quality businesses can be resilient and kind of take advantage. So if you are a high quality business that isn't at death's door, you can expand and maybe you acquire a competitor that's been weakened, or just launch new products. In the US, we're seeing incredible stuff coming out of Amazon with this, where they, I think, kind of just emerge so dominant as a result. Yeah, those are the kind of things that I'm looking for.
Yeah, that's an interesting case study in InvoCare. I guess one of the things that you look for is capital light businesses, and we can throw that around for days and it sounds great, but in your mind, why is that important now?
Yeah, so it's particularly valuable now if you're not dependent on capital markets, basically. So the first is we're looking for businesses that can expand no matter what happens, and if you don't require a huge amount of capital to expand, that's pretty valuable. Also, capital-intensive businesses tend to be financed with a lot of debt, and so, or even their competitors, and even if your competitors are kind of in a debt zombie land, it can be quite damaging for you. So I think that those two things is where we're seeing most of the damage. All this call for bailouts, which generally I'm not really a supporter of equity bailouts. I think you can save the operating business and the employees without that. But there's generally companies that have a lot of debt. That's the reason why they're in trouble. It's very rare that an operating business without any debt is facing any survival challenge. So yeah, that's generally it goes kind of hand in hand. Is companies that are capital light don't tend to need any debt. Often they have net cash positions, and it means that you're more flexible. So you can scale things down more quickly as well. If you have a big factory, that's a large fixed cost. So being capital light often means, not exclusively, not always, but often means that you have more variable costs. You can just turn things on and off. So we see that with some of the travel agents. I think some of them have a big brick and mortar presence, and that's very potentially kind of life-threatening for the business. Others are purely based through online, and when online you can turn off your marketing, and it's very painful, but it's not as threatening. So yeah, that's what's going to be interesting, and just studying. I'm always interested in moments of change, and that's most of what I look for. So this is like one of the greatest, probably the greatest we'll ever see in our lifetimes, I think. I'm not talking just, I think maybe just buying the markets at the bottom or now it's be a really great opportunity, but it's more that dispersion between different businesses that's just going to be huge. It's such a driver of change in so many ways.
Yeah, it's just such a peculiar time insofar as volatility. It's been, in terms of records, we've seen plenty of records in terms of up moves, plenty of records in terms of down moves. So there's a lot going on, and like you said, bringing forward the adoption curve is a really interesting idea. I'm curious if you have. I know you are about to launch a fund, so I get you're knee deep in research and all of that. But if you have any examples of companies that potentially are coming forward in terms of the adoption curve, like I could maybe just come up with some themes, which would be video conferencing, for example. We're recording this via Zoom. I think Zoom is the most talked about technology company globally right now. But then you have many other tools like Microsoft 365 and Google Cloud and all these different types of I guess thematics that are going to be pushed forward from this. Is there any sector or technology that you're looking at locally and thinking that's really interesting?
Yeah, there's quite a few, I think, around anything remote, online learning, pushing to online shopping, all these things. To give some kind of concrete examples, I generally don't want to talk about too many names because we're about to launch, but there's a couple of companies I've talked about publicly before, so happy to chat about them again because they're quite relevant here. So one would be Pushpay, so a company I've written about the art of the deal and their kind of acquisition strategy. So Pushpay provide, as you know very well, provide giving solutions for US churches, particularly allowing them to have an app to engage with their members, and then those attendees are then able to give through the app, and it's replacing passing around the collection plate and checks, and you tend to see more reliable giving, and it kind of works for the church and more engagement. And people it's very hard to understand in Australia and New Zealand because it's just not that same culture here, but it's very big in the US, and they do a lot of good in the community and very kind of holding up a lot of community. And it's another great, interesting one because earlier your first jumping point would be that this would really struggle during this time because churches will need to shut their doors for a period. it's just going back to thinking through what drives the actual business, because up to the last time that they reported, which was in March, Pushpay had actually seen an increase in demand for their services because they enabled remote giving engagement, because people could watch the sermons through the app rather than having to be there present. I do think that I don't think it's just going to be pure plain sailing. So I'm constantly checking that thesis and seeing, because there are now actual shutdowns, but coming out of that, it's just such a selling point, right? When you're trying to drive that adoption, right? That shift from check, where most giving is still check. Pushpay has just a few percent market share of the total 120 billion that's donated in the US. If you can just bring that forward a few years, that's hugely beneficial. And I think that it's going to be very easy to sell any church they're talking to on why you should have this ability. So yeah, that's a good example of something that's not obvious. Need to do continuous channel checks on it. Another one that I owned for a while, and I've talked about again, is A2 Milk. That's another example where China shut down, and it kind of sold off because a lot of people were quite nervous around what that would mean. But you actually saw an increase in demand. And why did you see that? Because Chinese mothers became even more health conscious than they were before, and A2 Milk infant formula is seen as an ability to buy something high quality and nutritious for kids. And so yeah, you see that all brought forward, and for you have to continuously monitor that again, because it can change. But yeah, something that a couple of examples. Yeah,
that's an interesting one. When you talk about channel checks here, I like how this is I think a thing that not many new investors think about, is kind of circumventing management and getting that channel check right. So going to forums, going to people on the ground and actually speaking with them is so valuable, because you either confirm or I guess deny what management is saying, because they can make things sound very well with a lot of doublespeak and what have you. In terms of A2 Milk, I'm interested there. How do you think about channel checking in that way?
There's been a lot of things I've done with A2 Milk over the years. So just when it was selling out in supermarkets in Australia, just checking the tins, making sure, see when the expiry dates are, you can see when they were manufactured, how rapidly it's been turned over. More recently, it's become so China focused. It is checking things like forums. It's talking to people who either are Daigo or friends with Daigo, and can kind of see what some of those channels are. And it's just really just trying to get up in some of the big online portals in China. So yeah, it's a lot of that stuff. It's not easy. Another thing that we've been looking at is export volumes out of Littleton Port in the South Island of New Zealand, which exports infant formula. And that's become a bit messy more recently, unfortunately, because there's some other volume going through there, but that had been quite a good indicator. And yeah, what we've seen is they continue to take share. So they've continued to report very strong numbers. I think it's not always, I think you're looking for disconfirming evidence continuously. Like you're not going to get a direct read on anything, because you're just looking at all these alternative data sets. But the more different pieces you can bring together, the more that mosaic kind of fits, and you have a view of what the real world looks like. And another thing I'm trying to emphasize more now is just talking to people, and particularly our investor base. Like the investors we're very fortunate. A lot of them are small business owners, they're professionals, they're executives themselves. There's a huge amount of knowledge there about just different parts of the economy. And yeah, we're definitely looking to tap that. And if any of our investors have something that they've noticed, whether it's in their hobby or their business or their professional life, something that's new and emerging, that's where we want to be. Because we're, as I said, that inflection point just before things really ramp up, and we want to be noticing those. So yeah, just trying to find as many ways to do that. If you're listening to this and you have any ideas, feel free to flick us an email. But yeah, just getting outside of that bubble, as I said, talking to everybody and trying to understand what's going on.
Yeah, it's interesting because you talk to these ideas, and you like you said, you're looking for disconfirming evidence. And I think, the only truth is that you don't know what is exactly going to happen. And for me, it's kind of piecing together multiple sources. And when it comes to investing, it's just asking a question, what sucks? So what is it about this that makes it, would make it go wrong? And then trying to find evidence which I guess confirms that, or, and in turn disconfirms your thesis entirely. So you're constantly seeking that out. And one of the best resources you have is the people around you. I remember I was up in Sydney not so long ago with you actually, and we had a value investor program going on up there, and some of the people in the room, as we're talking about Pushpay, had firsthand experience with it. So, these are great resources that you can use. In terms of Pushpay, because you've used it as an example, I'll run with it for now. We see some of these companies, there's flight to quality right now. I guess this is a generalized question, but Pushpay is a good example for it. Are investors at risk of overpaying for these businesses now? Because expectations, if we're thinking linearly, have been brought forward so far that maybe we're overcapitalizing into the valuation.
Yeah, I would say I think Pushpay is more fair than some other ones because it seems to be holding up a lot better. But I think generally there's a lot of companies that I'm amazed at the prices they're trading for, and I'm talking about businesses where there's going to be a very negative impact. And it's true, like there's been a lot of comment that if you just delete like 1 year's earnings, then that doesn't really affect the intrinsic value of a business that much because you've got so many future years. But it's also that kind of ignores, I think, the competitive dynamic of a business that starts going backwards. And you definitely want to be modeling out, the cash flows for perpetuity. That's what we do. But you need to think if your company is it's not just a zero. It's not just they just don't do anything. That's negative, right? If they're losing money during that period and another competitor isn't, or maybe a substitute good isn't, then what happens then? Maybe the whole dynamic starts to change. So I think there's been a lot where people are pricing in, more so in the US because I think it's less likely there, but pricing in like a V-shaped recovery, as they call it, and seeing there's going to be a huge change back. I don't see that. I think with all these things, as you said before, like we don't know the future. I think you need to think probabilistically about it. I don't see a high probability. That's not kind of my base case. It's not the most dominant one, just because of the way that it's been managed there, where unless you have a vaccine, I think even if government shutdowns lift, you won't see a lot of people kind of returning into those things very quickly. So yeah, a lot of tech companies have really rebounded. And I think something I'm watching closely is how a lot of these tech companies go when nobody's buying their products as a new signups, right? So some of them have recurring revenue, and some of that will be sticky. But I've heard plenty of other cases of a lot of these customers calling every SaaS provider and asking for a 50% discount. And depending on the business, some of them are just giving it, they give a third 33% discount. That's a pretty big difference to your margin if you're at like a 20% profit margin and you give away 33%. So yeah, I think it's just really, again, it's just knowing what's really going on with the business. Is it so mission critical people don't think to do that? Or is it actually, they've been earning pretty well for a while and maybe they're very profitable and they can afford it and everyone does get a big discount. So yeah, all that stuff is things that I'm thinking about.
One final one I'd like to ask is on the topic of these SaaS businesses, software as a service. For quite a while, analysts and investors have baked in a lot when it comes to companies saying, we've got 80% recurring revenue, 90% of our customers are retained next year, these types of things. And that, I fielded a question on this last week from our members, and it's kind of like, how do you think about that in terms of if some of these companies are handing out 30% reductions in their annualized contracts or whatever, how do you think about that in defining which companies are likely to give into that pressure from customers versus those that don't? Are there any defining characteristics of companies which are indeed, wide moat businesses?
It really comes down to understanding kind of the competitive dynamics of the industry itself. I think we talked about this on the last podcast and other times when we've done presentations, but there's this idea that the certain amount of value is created in the industry and it's captured by different competitors, different players in the industry based on the ability that they have to kind of defend from basically from competition. So the primary force of all Michael Porter's 5 forces is barriers to entry and competition. I think that's the deciding factor, and it's just trying to think through that, because if you're in a business and someone calls you and asks for 33% discount, the reason you give it is because they say they're going to go to a competitor. If that threat isn't real, if it's very hard for them to go to a competitor, that's when you can resist that. And so that really comes down to how easy it is to switch and how easy it is for a competitor to take the business of the company that currently has it. So I guess it's really doubling down on that. I think a lot of things, particularly with SaaS, has been moved to the cloud. So you've seen this adoption curve, which is great. But during that time, it can hide like the true competitive positions of companies because everyone's moving to the cloud, right? So if you have 10 competitors, they can all often stay in there during that hyper growth moment, and then it's to the top of that S curve where things start getting washed out because suddenly the projections aren't what they thought. And so I think we're just seeing some of that, basically. I think we see a shakeout into the few that can handle it. And some of the companies that even lose revenue could still emerge a winner, right, as long as they have a bigger balance sheet and their competitors can't. So that's still something to think about. But generally speaking, it's just trying to find those that are mission critical enough to avoid being shaken out at all, and where their customers. So there's two things. One is the customers, whether they're going to try to get a reduction, or whether customers even can pay. So there's a lot of industries where I think you need to think about the health of your customer. And I think this is, again, as I said, we see really high quality businesses lead through this, and high quality businesses aren't just thinking about extracting the most value. It's also about creating value. So it's growing the pie and then capturing as much of a share of that as they can, but it's about growing that for all stakeholders. So if your model has been kind of predatory, that probably gets exposed a bit. Whereas if you've been creating value, you're probably going to be rewarded during this time. Customers are less likely to try and take it from you, or you could even find a way to add more value to them during this process. So yeah, it's just a very big divergence. Again, as I said, probably the biggest we'll ever see, I think, over the next kind of 6 to 12, 18 months.
Yeah, as you said at the very start of this conversation, it's one of those things where you've got to put yourself in the driver's seat of the company and actually understand what is moving that business. And if you don't, you're effectively flying blind in a time like this. As we come to the end, Matt, just to recap, where can people find out more about you?
Yeah, so mavenfunds.com.au, mavenfunds.com.au, or mattjoass.com, mattjoass.com.
Yeah, and you've put some updates, as you said, you've written about Pushpay quite a few times on your website, so I'll provide some links to that. And you're also on social media, right?
Yeah, absolutely. Yeah, get in touch. Always keen to chat. So yeah, feel free to reach out.
Great. Matt Joass from Maven Funds, thanks for joining me, mate.
Thanks very much, Owen. Pleasure.
Cheers.